Give us a sense of what you learned, if anything, through this somewhat tumultuous week.
Yeah, so I think the word I would use to describe this week, David, is moderating. Moderating. We came off a quarter of just torrid earnings growth, right? 90% earnings growth, and now we're looking at the economic data to try to figure out what the future holds. And as you said, we saw declines in consumer confidence, declines in retail sales. Declines in the mortgage market, right? Modest declines in the mortgage market, which has been very strong. On the other hand, we see corporate America continue to do well, industrial production up. So, things are moderating, and that's normal at this point in the cycle. That's normal at this point in the cycle. You can shut down an economy all at once, but it opens in an uneven pace, and I think that's exactly what we're seeing. And investors are looking through that and looking ahead.
Well, that's my question. What are you hearing from customers? What are they saying? Are they nervous about this? Are they pretty sanguine? They think it's all going to come out okay?
One of the things I think that we have learned through this crisis is how quickly things happen, how quickly a virus spreads around the world, how quickly you can close down the economy, how quickly the market can sift through all that information and react, right? We had a 6-week bear market, and the market completely recovered in 6 months. So they're learning to sift information very quickly. One of the other pieces of information we sifted this week was the news about the coronavirus and the need for booster shots, right? The market's weighed that, understanding it, is looking forward. And again, the market always looks forward a few quarters. And looking forward, we continue to think the economy is healing. We're growing at a 6% rate. That's 3 times what we were growing at before this crisis. And we think there's a lot of support for markets.
Catherine, on Wall Street, we talk a lot about investors. Let's be a little more precise about who these investors are. Right. You pointed to a piece on the Bloomberg actually this week about Fidelity, which reported that the number of 401ks went up something like 85%. The number of IRAs went up 75% of people with $1 million or more in them. Is there a fundamental shift coming in who these investors are, that is retail versus institutional?
And that is exactly the right question, David, because the structure of the markets has changed during our lifetimes. Today, the retail segment of the market, the assets that are governed by individuals, is larger than the institutional segment, and it's growing faster. And there's a reason for that. Corporate America has fundamentally changed the way we save for retirement. Our parents' generation, they probably had a defined benefit plan. They retired with a pension, an annuity for the rest of their lives, and their personal savings. Today, we save for our retirements ourselves. If we work for a great company, we're lucky to have them contribute as well, but it's defined contribution plans, it's 401k plans, and our personal savings that make us ready for retirement. So that's why you see this happening. I think one of the interesting things about that story is it does show the power of investing over the long term. The average age of some of those folks with the $1 million accounts was 58. So it shows the power of investing over time in markets that do go up over time.